Welcome. In this video, we will understand Schedule M1 for partnerships using a step-by-step approach and see how book income is reconciled to tax income for reporting on Form 1065. Let's start with the profit and loss account as per books. We have service revenue of $2 million, along with other income such as municipal bond interest, life insurance proceeds, and other income. On the expense side, we have operating expenses, depreciation, provisions, and other costs. After considering all items, the net income as per books is $497,000. Now the question is, will this book income be the same as ordinary business income for tax purposes? The answer is no. We begin with book income as per the financial statements, which is $497,000. This will now be adjusted for tax purposes. These are adjustments that increase taxable income. Items like accrued bonus, entertainment, and fines are either disallowed or not yet deductible for tax purposes. Prepaid rent is taxed when received, even though it is not recorded in the books. Charitable contributions are separately stated and therefore added back. These are items that reduce taxable income. Municipal interest and life insurance proceeds are not taxable. Also, tax depreciation is higher than book depreciation, resulting in an additional deduction. After adjusting book income with additions and subtractions, we arrive at ordinary business income of $457,860. Notice how certain expenses are added back because they're not deductible yet, while some income is removed because it's not taxable. This is the core idea behind Schedule M1. This amount ties directly to Form 1065, where it is reported as ordinary business income. Unlike corporations, partnerships do not pay tax at the entity level. Instead, income flows through to the partners. This distinction is important because, unlike corporations, partnerships don't pay tax themselves. The tax responsibility shifts to the partners. This income is reported on Schedule K at the partnership level and then allocated to each partner through Schedule K1 based on their ownership percentage. Think of Schedule K as the summary at the partnership level and Schedule K1 as the distribution of that income to each partner. Some items are reported separately because they may affect partners differently. These are called separately stated items, such as charitable contributions and tax-exempt income. These items retain their character when passed through to partners. These items are separated because each partner may treat them differently on their individual tax return. Here we can see how the income and deductions are reflected on the partnership return, leading to the final ordinary business income. To summarize, book income is not the same as ordinary business income. Schedule M1 helps bridge that difference, and in a partnership, the final income flows through to the partners. Understanding this flow helps you connect financial statements to tax reporting in a structured way. This video is for educational purposes only and does not constitute tax advice. Please consult a professional for your specific situation. Subscribe for more simple and structured U.S. tax explanations.